Hey, in today's video, we're talking about 7 critical tax years that you need to plan for in advance in retirement. Some years are more monumental than other years tax-wise, and so if you know these years are coming, we can do some planning in advance, and that's what we're talking about. 7 critical tax years that you need to have a plan for. Coming up next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees retire better. And so if you need individualized help, go to christycapital.com and click Talk to an Advisor. When we think about future tax years, there's a couple of things that we need to keep in mind. As you're looking at your planning, maybe there's going to be some years where you want to show higher income. And there may be some years where you want to show lower income for different reasons. It's important to plan ahead. First, let's talk about the difference between an effective tax rate and a marginal tax rate. The effective tax rate is only known after the fact. Some of your income gets taxed at 10%. Some of your income gets taxed at 12%. And so as your income gets higher, you'll pay 22% on some of that money. Now, your effective rate is in essence the average tax you paid. You take the amount of tax you paid divided by your income to come up with the average percentage of tax paid. Now, the marginal tax rate is the tax rate you'll pay on your next dollar of income. So if you're in the middle of the 22% bracket and you decide to do a Roth conversion, you're going to pay 22% on your next dollar of income. Your marginal rate is 22%, but your effective rate may be 17%, let's say. When we are planning, we have to plan with the marginal tax rate. If you do a $20,000 Roth conversion, you'll be paying at the marginal rate. You won't be paying at the effective rate. So as we're planning for retirement, we need to look at what is your marginal tax rate going to look like right now? What tax bracket are you in right now? And then what does your marginal tax rate look like in the future? What tax bracket are you going to be in the future? So here are 7 years that are going to be critical in your retirement planning. The first one is the last year that you work. What income tax bracket are you in going into the last year that you work? If you're trying to do a large Roth conversion and your income is really high that last year of work, it may make sense to postpone some of those conversions. Maybe there's a large distribution that you want to take at retirement and you're going to retire in December of that year. It may make sense to wait and take the distribution in January because you've been working all year and presumably your income may be higher if you took it in December. Now, the second year to look at is the first year of retirement. What stands out to me is that the first year of retirement, you may be getting an unused annual leave payout that may increase your income. Maybe some of the year you worked and some of the year you retired. Knowing that first year's projected income helps set up some planning opportunities. So the third critical year, is maybe there's going to be a year where in advance you're going to have either large income or large distributions. That can be important. For some people that we work with, we're developing a Roth conversion strategy where we're going to Roth convert certain amounts each year. If you know in advance, there's going to be a year where you're going to have a large distribution, which may mean you're going to have an unusually large income that year. It may mean that you can't do much Roth conversions. Knowing that in advance can help us with the planning. Let's say you have $1 million traditional TSP balance. Maybe after going through some of the planning, you want to have an account fully converted over 10 years. Well, at first you'd say, I need to convert $100,000 a year for 10 straight years, because that would equal $1 million. But remember, your account will keep growing. So depending on what you have invested in, the balance will keep growing. So you'll actually have to convert more than $100,000 a year, or you'll have to do it longer than 10 years. If you know at retirement, for instance, that you want to take a large distribution and pay off your house, that probably means you can't do a Roth conversion that year. If you're working on a 10-year timeline, but you can't do Roth conversions one year, you'll need to adjust your planning. The fourth critical year is 2 years prior to you turning on Medicare. As a federal employee, you have the choice to turn on Medicare or not to turn on Medicare. If you carry your FEHB into retirement, you don't have to turn on Medicare. Your federal healthcare will act the same way in retirement as it did while working. But let's say that you want to turn it on. Well, then what's important about 2 years prior to turning it on? Well, your Medicare premiums are based on your income level 2 years prior. So let's say that you're going to turn on Medicare at age 65. Your taxable income at age 63 will be used to determine the premium amount you pay for Medicare. So let's say that we've worked up a Roth conversion schedule to move your traditional to Roth and get the heavy lifting done. And so it requires us to do rather large Roth conversions, which will cause your income to be higher than normal. If that income is too high, and it goes over some thresholds, it can cause your Medicare premiums to go up. Knowing that in advance helps. If you have $1 million TSP or higher, it's going to take some large Roth conversions to get the heavy lifting done, to shift the money to tax-free. Those large conversions can cause your income to be high enough that Medicare premiums could go up. One fix would be that you decide that you don't even want to turn on Medicare. If you've chosen to keep your federal health care just like it is and to not do Medicare at all, then there are no limits anymore and you can Roth convert to your heart's content, with the only worry being the tax bracket that you want to stay in. That's one solution. The other solution is Roth converting up to the 22% bracket, but not higher. A Medicare surcharge threshold is just over that 22% bracket. But if you have a healthy pension and 2 healthy Social Securities and $1 million plus TSP balance, sometimes Roth converting up into the top of the 22% bracket doesn't really move a whole lot of money. It may not move the needle at all. So at that point, you'll have to decide which is more important. In the long run, will you pay more in increased taxes, or will you pay more in increased Medicare premiums? This is something that, if you're working with us, we can help you figure out the math to find out the right solution for you. But this is definitely a critical year to be thinking about in advance. The 5th critical year is the year that you choose to start Social Security. Working on our same thesis that we are trying to shift money from traditional to Roth by filling up the tax brackets to a certain level that you're comfortable with, by doing Roth conversions. If you suddenly turn on Social Security and you add that extra income, we need to know about it. It will affect other things. If your strategy says to do a $100,000 Roth conversion every year, but then you turn on Social Security, the Social Security income will fill up some of that tax bracket for you, and it may mean that you have to lower the amount of conversions that you do. Every decision has a consequence. Turning on Medicare may change the amount you can convert. Turning on Social Security may change the amount you can convert. All of these decisions have consequences. Now, this doesn't mean that you don't turn on Social Security. It means you should know about it in advance and have a strategy built to accommodate it. The 6th critical year tax-wise is the year that you start RMDs. Now, RMD stands for your required minimum distribution from your traditional retirement accounts, whether it's traditional TSP or traditional IRA. Those RMDs require that you take out a minimum amount. And so depending on your birth date, it may be 72, 73, or 75. Now you'll be forced to take the amount out, and the amount is taxable. Now many times when we're first working with someone, we will go over a financial plan with them. And one of the things that we definitely look at is how much is that RMD going to be and what will it do to your tax bracket. If you have a large TSP balance that's traditional, at age 60, you're probably going to have a really large balance by your RMD age. We just met with someone last week whose RMD was going to be $127,000 that first year. Now imagine what an extra $127,000 of income means for your tax bracket. Now in this person's case, they did not need to take the distribution for funding their lifestyle. They're being forced to take it, and it's taxable. So in that person's case, it bumped them up into the next tax bracket. One of the goals of doing Roth conversions is to get your traditional balance low enough so that when you arrive at RMD age, you either don't have an RMD at all, or you have an RMD that's small enough that it helps fund your lifestyle and it's not really a big tax consequence. Unknowingly going to retirement just to show up at RMD age and have a $127,000 RMD and then getting kicked up to the next bracket is not what we want. Realizing this is going to be a problem in advance gives you time to fix it. There are some things that we are helping our clients with. And so if you think you would benefit from this type of help, go to christycapital.com. And then the last critical year for tax planning purposes would be either the year of your death if you're married, or the year of your spouse's death. So if you're married and you're filing taxes married filing jointly, then you're in a certain tax bracket. If you suddenly get bumped to the single tax bracket, most of the brackets get cut in half. Now granted, the lower Social Security will go away at the death of a spouse. And so depending on if it's the federal retiree that dies or the other spouse, the pension might go down some. But the large RMDs are still going to be there for the remaining spouse. Getting moved to the single tax bracket can act like a tax increase because you run through the tax brackets much faster. Your income may go down some, but it usually does not go down by half. But the tax bracket does go down by half. So if you don't do proper planning, you could end up paying a higher tax amount on your traditional TSP, all because the RMD kicked in and your spouse got moved up to the higher tax bracket. This is avoidable. You can do planning between now and whenever the death of a spouse happens and pay taxes at the married filing jointly rate. So at the beginning of this video, we were talking about what does my marginal tax rate look like now, and what does it look like in the future? Well, if huge RMDs kick in, your marginal rate could look worse. If you get bumped to the single tax bracket, your marginal tax rate could be worse. If Medicare premiums and your unwillingness to pay more on those premiums causes you to not Roth convert as heavily, that may cause you to pay higher taxes later when your RMD kicks in. The best fix to these tax issues is to figure out whether you're going to have them or not. Assuming that you keep your money just like it is, which for most people it's traditional, are you going to have tax issues later? Diagnosing that problem early is key. That will give you more time to fix it. Figuring out that you're going to have a huge RMD problem 1 year before your RMD kicks in is not all that helpful. Finding out you have a tax issue after the death of your spouse is not all that helpful. All of these things can be diagnosed and figured out in advance, and we can come up with a strategy to fix it. This is what we help our clients with. I think it is tremendously valuable, and it helps people not overpay the government. Everyone should pay the government everything that's owed, but you should not give them a tip. We should not overpay them because we didn't do the proper planning. That's avoidable, and that's something we help people with. So if you're watching this video and you have $800,000 or more in your TSP and you're 59.5 or over, you have the potential of having tax issues later if you don't deal with them. Reach out to us. Let's talk over your situation to diagnose the problems that you may be having and recommend some solutions for you. Now, it sounds like we are very pro-Roth, and we are. But check out this video right here. Here are some reasons to not do Roth. Are there reasons that would cause you to not want to do it? Well, check out that video. My name is Mel Stubbs. Let us know how we can help you.